Hey, everybody, welcome to another episode of the Real CFO, powered by Kinsler Brown. I'm Chad Brown, one of the hosts of the show, and going solo today. I really want to spend a few minutes, not going very, very deep on some of these things, but I want to discuss the big, beautiful bill. That's the tax bill that was just signed into law last week by the president and extends a lot of the provisions from the TJCA back in 2017. So let's dive right into it. I'm going to highlight some of the things that are business worthy, some things that are going to impact businesses and small business alike. So anyway, number one, and it doesn't get a lot of play out there because a lot of small businesses may not fall into this category, but a number of mid-sized companies do. And so it's a good opportunity, especially with interest rates where they are. This was a big move. Business interest deduction. Now that's under section 163J of the code. And there were limitations put on businesses regarding the amount of total interest expense that they could deduct for taxes. And basically what it was, they would look at, everybody's familiar with the word EBITDA, right? Earnings before interest, tax, depreciation, and amortization, right? Well, for this calculation, you would get a percentage, it was around 30% limit of interest expense that you could take based on EBIT, earnings before interest and tax. Okay, so that means that depreciation and amortization were still taken out, right? They were deducted from that number, so the number would be lower. So let's say it's 30% and you have interest expense of $1 million, right? Or you have EBIT of $1 million, your depreciation or your interest deduction would be limited to 300,000. What changed is now the depreciation is added back. So it's 30% of EBITDA. So now you're going to be working with a lot larger number because you're adding back depreciation expense. So in our same example, let's say you had depreciation expense because you went out and bought brand new equipment and things for the factory. Now you've got $2 million of EBITDA, 30% of that, 600,000. So there are caps, but that was a big deal for a lot of small businesses. Another one is the qualified business income deduction. Now that hits everybody. It's nothing new. It was part of 2017 law, but it was going to go away, so it's been extended. What that did is give small businesses, S corporations, partnerships, sole proprietors, the deduction, qualified business income deduction of 20% off their business income. There's some add backs and qualifications. This is section 199A deduction. If you hear that, is a big deal because when the corporate income tax rates were lowered to 21%, the C corps, this was the way to kind of mirror that for smaller businesses that file on their personal return because their business income, whether S corp or partnership, flows through the personal return. So it's a big deal that it got extended. There was talk that it would be up to 23%. Final bill did not have that. So again, a great deal for businesses. And this is one, the next one is one that I don't think enough businesses pay attention to, especially new businesses and as they're forming. It's the qualified small business stock. It's section 1202. That has been law for a number of years now. And what it basically said, and it's certain business apply, everything I'm saying here, there's qualifications, there's exemptions, there's things that we have to look to. So this is kind of a broad focus. But basically, if you have a C corporation, original issue stock, and you start that business and you hold it for 5 years, and then you sell it, that first $10 million of gain is tax-free on the federal level. Okay, so that's been around for a little bit. This law changed it and changed the amount to $15 million. It's a big deal. If you're looking at starting a business, creating a product, service, and and selling out in 5 years. You have to hold for at least 5 years, and it has to be original issue. It could be a massive tax savings to set up this way, but most businesses, when they start, they set up as an LLC, and then they are taxed as an S corporation. And that's what you hear out there on the, TikTok and everything. Not too many people say, hey, you should consider setting your business up as a C corporation or that. But this law and the extension of it and the increasing of it is a big deal. It's a big deal, and it's something that should be considered. Corporate charitable contribution deduction, some changes to that. There's a 1% taxable minimum. That means businesses have to contribute at least 1% of their taxable income floor before they can deduct that charitable gift. Now, this is on C corporations, right? Because on a S corp or partnership, that all flows through to your personal itemized deductions. So it's really trying to encourage C corporations, your larger companies, to contribute more, right, by incentivizing them and putting some limits on it, right? So step up to at least 1% of your taxable income, or you're not going to get to deduct it. There's some international tax provisions. I'm not going to dig into that. We don't deal with too much international. Opportunity zones. The opportunity zone program, if you're not familiar with it, is if I have capital gains and then I reinvest, say I sell some stock or my business, and I have capital gains. And say, for example, I have $500,000 in capital gains, and I reinvest that into opportunity zone property, and I hold that for 10 years, I get to exclude those gains on that opportunity zone from income. Okay. So it's incentivizing us to invest in areas that might be a little bit depleted or need some rebuilding, inner cities, rural areas, maybe not a lot of infrastructure or business. It's incentivizing us to invest in those areas and then hold that investment for 10 years. And they're scalable in the number of years. Again, broad, we're not going too deep. And encourages you to hold that there for a long period of time. The gains are going to be tax-free. So it's something to consider, right? So that way, if you make a sell and you say, hey, I'm just going to put this over here so I don't pay that cap gains tax on my capital gain. Hey, worth a play. Employer-provided child care credits increased for that. That's a big thing. Paid family and medical leave. The credit, which has been around, is made permanent. The credit is, 12 and a half, I believe, to 25% of wages paid during qualifying leave. So employers offering this leave, offering paid family medical leave, can reduce their tax bill simply by paying, if somebody's on leave, paying them. And then you get a credit for that. So it's a big deal for businesses. Another one that everybody is talking about is bonus depreciation, 100%, brought up to 100% levels, which is fantastic. And the Section 179 provisions that were extended. So, and the baseline amounts, I believe, went from 1.2 million eligible for 179 up to like 2.2 or 2.25. Don't quote me on that, but those are big deals for businesses. So one thing that you need to start doing is instead of saying these don't apply to me or I won't benefit from that, change that narrative. How can I? Okay. In some ways, you might have to think outside the box. In other ways, you might have to reinvest some dollars into the company, back into family medical leave, back into other things that will benefit your employees and your team and your culture and everything, right? How can I? Don't say this isn't for me, right? And there's more and more things that are in the bill that we probably haven't gone over. I didn't want to take this too long because I know when we talk tax and get in the weeds a lot, it can turn people off. But anyway, 100% bonus depreciation is restored. The 179, Section 179 cap rate is up to 2.5 million right now. And then the QBI was extended. There's expensing of R&D expense. Oh, this is a good one. So previously, a lot of R&D expenses had to be amortized, right, on the balance sheet. It had to be put on the balance sheet and then amortized over 4 years. the new law passes, says R&D expenses can be expensed immediately. And so now we can go back to 2022, actually, for companies that were amortizing those and recap and go ahead and expense those. Okay. So that's a pretty big deal. And I know a lot of smaller businesses say, I don't qualify for R&D. Well, you might. There might be some things in there that you are doing. I'm not sure. But anyway, that's a big deal for a lot of companies as well. But yeah, that's what I got for you today. I hope it's worth your time. There's some information that we'll be sharing over the coming weeks as we gear up for what we call kind of the planting and planning season, where we're really working with our clients and looking at their financial statements, making sure we know where the exposure's at and how we can best manage that in relation to these this new legislation and some of the other strategies that we've had in place for a while now. So anyway, we'd love to help you guys. Our job here is to enhance the growth and financial well-being of all of those that we serve. That's our small business clients. That's our individual clients. So there we haven't got into the individual side yet, but there's a lot of stuff on there as well. So stay tuned. We'll be sharing more. And if you need anything, just ask, right? Shoot us a message. You can hit us at realcfo@kintzlerbrown.com, realcfo@kintzlerbrown.com. We would be happy to answer any questions that you might have. No pressure, no nothing. So anyway, appreciate you listening. Bye, everybody.